Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for ChartsandMarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob.
Yeah, good morning, Jim. Always good to be with you on our Fridays, and with our listening audience out there in the space.
And our listeners are always curious and like to pick your excellent brain. And we have several questions today. The first one, with the S&P top with the RSI around 90, would wreck a bunch of shorts on the way up, then destroy longs on the downside. Sounds like Mr. Bear to me. Your thoughts, sir?
Well phrased. Yeah, the RSI is, for other listeners, is a momentum indicator, and we use the weekly. And when the RSI weekly gets up to 90, I mean, that is big time. That's what happened with the gold and silver huge promotion that peaked in 2011. Various things got up to RSI 90, which we noted then. So, yeah, one of the things that we've been expecting, Jim, has been the probability of a sharp rally into early September, and which we're getting. So, and it's probably squeezing some shorts, but I really doubt that the S&P could get up to a 90. That would be amazing. But also, I like the reader's point that destroys the shorts on the way up, and it destroys the longs on the way down. That's true for sure. So, good question. Thanks.
Justin Lee writes, hi, Bob and Jim. Bill Gross declared treasuries, especially the long bond, as trash investments, up there with cash is trash. If 60% of the market of bond issuance is quantitative easing, then how can the Fed taper purchases at all? Doesn't the Fed use QE to create a market for treasuries and buy assets like stocks to prevent massive deflationary crash? Isn't the Fed stuck doing this forever? Thanks again.
Yeah, Justin, you got some points there. Bill Gross is not a bond trader, and I think he said that halfway up when the bond future rallied from, in March, 154, and it rallied up to 166. We had the buy on that one as well, but it got a little overbought at 166, and we're in for a period of correction on that. But what I think will happen is, as this stock market rolls over, it's going to be the flight to quality, which will include the long end of the treasury market. So there's another leg up. It could be quite exciting. This is what happened in the COVID panic. People went into the long bond as a safe haven, and in an instant it became a wildly traded item. So, timely question. Thanks a lot.
From RJ, hi, Bob and Jim. My question is on junior mining companies. When these companies do a financing, I notice that the share price usually goes down afterwards, especially when there's a warrant attached. Is there a quick rule of thumb method to estimate how much a stock might drop after a share issuance?
No, that's too much detail for me, and I can't make a comment on that one. The only juniors I get in are ones that I'm involved with from the start. So, and occasionally you see an opportunity. One of your friends is involved in a company, and you have a chance to do take a piece of a financing. But no, That's too detailed for me.
Second question from RJ. In regards to shares outstanding, is there a number for outstanding shares that Bob looks at when considering a stock for purchase? So if the share count is too high, he won't consider it or consider buying it due to the dilution factor. Thanks in advance for any information, and I always enjoy your interviews.
Yeah. That's an important question because in a quiet market, if you got a gold exploration stock, valuations count, and there's certain levels where you can finance at, and like if you have 100 million shares or something, maybe you're getting to be too much. But it's that gain is another one of these awkward, timely things where you've got to make the judgment on it yourself, and I just deal with them as they come along, different stories. So.
We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, some of the headlines that caught your attention today. Evergrande flags default risk from cash crunch. What's the story there, Bob?
Well, that's the financial agency in China that was the darling of speculators on the way up, and it was lending money to anybody at any leverage and all that sort of stuff. And then it maxed out and has been contracting since. So, gosh, there must have been, over the last 5 or 6 months, there must have been about 10 headlines about Evergrande. So this is what happens in a market like this. There will be one or two really leading stocks for action and excitement and all that, and then it maximizes and then starts to come apart. In 1929, for example, in London, there's a guy by the name of Haptree, and he had made a lot of money parlaying different deals on the bull market then, and he was set to put together a number of steel companies in England that would have created probably the biggest steel company at the time. And early in 1929, he thought he had all the financing set up, but then as the year went on, various people dropped out until eventually he was carrying the whole thing himself, hugely leveraged. And he knew the deal was big, so he figured that if he failed, then it would bring the whole market down, which was a little egotistical. But he did send word to the Bank of England that they should, if they didn't want the market to fail, they should help him out. But of course, they wouldn't do anything on that. And then after September the 3rd, which was the high in New York, the market did go all to hell. So, but in England, for a while, some of the articles blamed the crash on the Haptree failure, when actually a broader view would point out that it was a huge speculative bubble, and it ran its course and then got hit. So, yeah, but interesting that this thing has lasted so long. Evergrande, I love the name.
U.S. home prices are soaring.
Yep, there's another one. It's the latest report there. Home prices are still going up. But I think in some regions there have been some downticks. But you can get strong residential real estate prices with a financial bubble. And then also with the post-bubble contraction, real estate prices for not just residential, but commercial and industrial can go down. There's been some excellent articles written on a major skyscraper in Manhattan. Jim Grant, the financial guy, Grant's Interest Rate Advisor, wrote a good one on that quite a few years ago, and we we used it, and he just detailed, I think it was the Excelsior Life Company, and he detailed that after 1929, it was a whole series of defaults by the owners and defaults by those who provided the mortgages, and it went on for a long time. It didn't start to get really beginning to get on side as a positive investment until the 1950s. And that was the same with the Chicago Showmart building, which was a huge building built in Chicago for all kinds of products and trades people to show their merchandise, and Chicago, sort of the center of the U.S. then for shipping stuff out. And it was built and opened probably right at the top of the market in 1929, and then it was empty. And Joe Kennedy of the Kennedy family bought it eventually, but too early. I can't remember when he bought it. But again, it took until the 1950s before that huge commercial property got back on side. So one has to have a long-term view, Jim.
Wall Street, the stock market rally continues to blaze higher.
Yeah. Hey, that's a good headline. And again, as I mentioned, on our work through the summer, well, first of all, we were looking for everything to be strong into about mid-year. And then August begin to show some reversals in key things like maybe commodity prices having a correction. Also the yield curve turning from narrowing to widening. And but then I always pointed out that New York in a bubble year like 1929 and 1873 did the final rally into September. So, and as I said, just in my memory at the moment, the high in 1929 was September the 3rd, 1929, and today on my calendar it says September the 3rd. Isn't that interesting? When we've had, and we do have, or we have had a hot market into this, in this week, but the things are starting to change, Jim. The transports are working on a classic Dow bear sell theory where the Dow Industrials can make highs and it's not confirmed by the transports. That's one item. The other is that we've had momentum stuff that's been very strong. And then now on the S&P, there's a pattern model we use that is giving a sequential sell. And as I mentioned, the credit spreads are reversed to widening. So, then we also had, a week or so ago, a Hindenburg omen. And I'll describe that one a bit because it's interesting. The Hindenburg, of course, is the German dirigible that burned so spectacularly in New Jersey in 1938 or something like that. So the Hindenburg is a disaster. So the Hindenburg in the stock market has to do with the number of stocks making 52-week highs and the number of making 52-week lows, and there's certain ratios in there, and they occur at tops, at high, speculative markets. Now, we did get one of those recently, and the key is that every Hindenburg has not been followed by a severe hit in the market, but every severe hit in the market has followed a Hindenburg. So that's it. So it's just another item, a fascinating technical thing. And then The other one is the margin debt, New York Stock Exchange margin debt. I saw a chart on that one back to the mid-1970s, and it, in the last year, has clocked the straightest straight-up increase in margin debt ever. And then on the latest posting, and this thing's usually about 4 weeks behind, on the latest posting it had a sharp downtick, which we're watching. And then the other one is the key to a bull market has been the breadth of the market. That's the number of stocks that are advancing compared to the number of stocks that are declining. And for the last 2 months, the AD line, 2 months ago, the AD line went up and made a triple top, came down with a noteworthy correction, and then as of this week is testing that high level. And my guess on seasonality is that the advanced declines, the breadth of the market, will not continue up. I think it's going to roll over and be a warning on the overall stock market. So, Jim, we live in fascinating times.
Bob, thank you so much for chatting with us and answering all those listener questions.
Jim, good to be with you, and looking forward to next week.
If you'd like to have Bob answer your question, you can send it to info@HowStreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.